One of the hardest parts of analyzing a potential commercial real estate investment is making an assumption around what you'll sell the property for when you ultimately exit the deal. And for underwriting and analysis purposes, your projected sale price has a huge impact on your returns and ultimately your valuation of the property that you're looking to buy or develop. But making predictions around pricing levels in the market 5, 7, or even 10 years out into the future is a pretty tall order for anyone, especially if you're new to the industry. So to help you dial in your assumptions if you're new to the business, or you just want to make sure you're using industry best practices to value your deals, in this video, let's walk through the 3 main ways that commercial real estate investors project out sale pricing when analyzing a property, and why each method can be a valuable tool in itself to tighten up your analysis. So to start off this list, I want to begin with what is by far the most common method used to calculate a projected future sale value of a commercial property, and that is the exit cap rate approach. This is the default calculation method used in every single institutional real estate financial model I've seen or worked in throughout my entire career, and this is really the industry standard across the board. And to explain the exit cap rate valuation method, we really need to first back up and start by defining the cap rate formula, which is just the net operating income of a property divided by its purchase price. And by using an exit cap rate valuation, we're essentially making an assumption around what cap rates in the market will likely be at the time we sell the deal, and we're also making the assumption that this is what's going to be used to value our property by the next buyer. And for that next buyer, this investor is going to be looking directly at their first year of net operating income, or really the 12-month period after we assume we sell the deal. So for our purposes, to come up with a projected value at exit, we can divide the NOI we believe the property will generate in the first year after our ownership period by that projected exit cap rate in order to calculate our sale value at that time. And to do this, most commercial real estate investors will use a general rule of thumb for underwriting purposes, assuming roughly 5 to 10 basis points of cap rate expansion or growth for each year of the projected hold period. So, for example, if we were to buy a property at a 4.5% cap rate today, and we plan to hold that property for 10 years, our exit cap rate assumption would generally be somewhere between 5.0% and 5.5% at sale. Now, some investment firms with access to a paid database like Real Capital Analytics will also use historical cap rates in the market to adjust this assumption up or down based on where current rates stack up against market norms. But if you're just starting out or don't want to pay for an expensive monthly subscription, this rule of thumb will usually give you a conservative, industry standard assumption around where market cap rates might shake out in the future. Now from here, another understandable question at this point is, why would an exit cap rate assumption increase over a going in cap rate on a deal? And the reason why this is the case is that essentially for all real estate investors and investment firms right now, all-time lows in interest rates have led to the belief that rates will inevitably rise at some point in the future, and with that, cap rates will also increase, directly reducing property values relative to NOI. Now again, the exit cap rate approach is by far the most widely used method for calculating a property's future sale value, and in almost all cases, this is the only method that you're going to need to use when underwriting a commercial deal. However, if you want to include a few more data points to back up that exit cap rate valuation, there are 2 additional sale value projection methods that are often used by commercial real estate investors as some sort of a backstop or gut check to make sure that that exit cap rate value actually checks out. And the first of these 2 methods is a replacement cost analysis, taking the current replacement cost for the deal being analyzed and then growing that value out into the future all the way out to your projected sale date. Now, if you're not familiar with the term replacement cost, this just represents how much it would cost to build a similar property in a similar location, and for most commercial real estate investors, buying an existing asset below replacement cost is a mandatory requirement when acquiring a deal. If you think about it, in most cases, it really doesn't make sense to buy an older, inferior property for more money than it would cost you to build a brand new building in that same location, especially since you'll be able to charge much higher rents and have fewer capital needs on a new construction deal. And for sale value purposes, to make sure the exit cap rate valuation checks out on a new acquisition, investors will often take the current replacement cost of a property, grow that value annually based on their projected future land value and construction cost increases, and then determine the replacement cost at the time they plan to sell the deal, and whether that ends up being higher or lower than their exit cap rate value. For example, if a multifamily investor is analyzing the acquisition of a property built in 1995 with a current replacement cost of $300,000 per unit, if they assume that land values and construction costs will grow at an average of 4% per year, when they ultimately plan to sell the property 10 years later, the replacement cost at that time would be just over $444,000 per unit. And to make sure that exit value makes sense, that investor would also want to make sure that their exit cap rate valuation ends up shaking out below that amount so that, again, a next buyer of the property would be able to check that box of buying below replacement cost. Now, for the most part, an exit cap rate valuation and a replacement cost analysis are going to be more than sufficient to model out a property's sale price in the future. But if you want to add an even more detailed method for calculating your exit value, some investors will also use what's referred to as a next buyer analysis as another data point to back up their valuation. And a next buyer analysis is essentially the exit cap rate approach on steroids, where the buyer of a property today will model out multiple years of cash flows for a next buyer of the property into the future, solving for a purchase price that will allow that next buyer to hit what they believe will be that next buyer's target IRR on the project. So, for example, if you're looking to buy a property today in 2022 and you plan to hold that property for 10 years and sell the deal at the end of 2032, a next buyer analysis would have you model out projected cash flows from 2033 through usually 2043, and then based on those cash flows, you would adjust your projected sale price or the next buyer's purchase price to a value that would allow that next buyer to hit what you believe will be their target returns on the deal. Now, in practice, a next buyer analysis is very rarely absolutely necessary, but this can sometimes be helpful in situations where the NOI is projected to increase substantially more than 1 year after you plan to sell the property due to things like affordable rent restrictions burning off or a major below market lease expiring at the deal. In these cases, a pure exit cap rate valuation looking only at the 12-month period after you plan to sell the property might not paint a clear enough picture around how a next buyer would actually look at your deal, and a full next buyer analysis multiple years out into the future can often be helpful in dialing in your valuation. Now, with all of that said, an exit cap rate valuation is really the gold standard in the industry, and this is generally all an investor will need to come up with a projected sale price on a potential acquisition or development project. However, if you're looking to back up that exit cap rate valuation, or you have some sort of extenuating circumstance where the property's operations are very likely to change significantly several years after you sell a deal, a replacement cost analysis and a next buyer analysis can both be great ways to get more granular in your pricing and to back up your sale assumptions to investors and partners. And if you want to learn more about how to use an exit cap rate valuation within a real estate pro forma, or you're looking to level up your real estate investment analysis skill sets and want to learn how to build out more advanced tools like a next buyer analysis in Excel, as always, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, our entire library of pre-built acquisition, development, and waterfall models for multifamily, industrial, office, and retail deals, and you'll also get access to private one-on-one email-based career coaching if you're looking to break into the industry and want some additional guidance and feedback along the way. And if you like this video and want to see more content on this channel on commercial real estate, underwriting, and analysis techniques, make sure to hit the like button to let me know, and let me know in the comments where you see cap rates going in the future and what type of cap rate expansion you're underwriting on new deals. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.